My name is George Lathrop, and this is Buy Now, Pay Later Loan Legislation White Paper. Imagine it's the holiday season. You have to buy Christmas gifts for your kids, parents, in-laws. You're tight on cash and you're waiting for your bonus from work to come in. You're shopping online, you're about to make a purchase, and you see an option that you started to see more frequently on checkout pages, pay in 4 easy installments. Buy now, pay later loans, as they're called in the financial industry, are an alternative form of credit and essentially work the way that they sound. Shoppers borrow money to buy goods instantly and then pay these loans back over time, often interest-free. You choose to pay with these small, painless installments, but months later, you're trapped with fees, struggling with missed payments. Over the past decades or so, retailers have been partnering with financial technology companies like Klarna, Affirm, and Afterpay to offer shoppers this service, both online and in stores, for everything from grand pianos to Chipotle burritos. Millions of young Americans face this hidden risk every day. Recently, 41% of people who use buy now, pay later loans in a recent survey said that they made a late payment in the last year. So what can we do about it? My proposed legislation, the Responsible BNPL Lending and Securitization Act, is designed to stop this cycle before it spirals out of control, just like it did in 2008 with the financial crisis. Here's how. First, it sets a hard cap, limiting BNPL providers to no more than 20 million loans per quarter. That slows the explosive growth and helps prevent unchecked lending to vulnerable consumers, as well as prevents regulatory capture in the buy now, pay later uh, industry without congressional approval, as Congress will need to approve changes that are made to that. Second, it requires that buy now, pay later loan providers actually assess your ability to repay. If your credit score or income doesn't meet a basic threshold, FICO score of 580 or an alternative, they can't just hand out a loan. This means that fewer high-risk loans will be underwritten from the start. Third, it forces companies that underwrite or securitize these loans to keep some of the risk on their books, just like we made mortgage lenders do after the 2008 crash and the Dodd-Frank. No more passing the risk off to the next investor. And finally, it locks in key consumer protections like the right to dispute charges, receive refunds, and get clear billing statements by applying parts of the Truth in Lending Act to BNPL lenders. That way, these companies can't quietly strip away your rights when it's convenient. In short, this legislation keeps the good access to flexible credit while cutting out the risky behavior that threatens consumers in the broader financial system. Over the past few years, buy now, pay later services have exploded, especially among younger Americans. A recent article from the Associated Press put it bluntly. Gen Z is drowning in debt as buy now, pay later services skyrocket. They're continuing to bury their heads in the sand and spend. According to Adobe Analytics, shoppers will spend 11.5% more using buy now, pay later this holiday season than they did last year, amounting to 18.5 billion in goods purchased using third-party services like Klarna, Affirm, and Afterpay. And it's not just big ticket items or electronics. Take Coachella, for example. This year, about 60% of general admissions tickets used BNPL to lock in their passes. With ticket priced at $600, some fans just paid $49.99 up front, with fees and the rest spread over 3 months. But it doesn't stop there. Festival goers also use buy now, pay later for outfits, hotel rooms, and even absurd $100 taco and lemonade meals. This isn't a one-off case. Lollapalooza and Bonnaroo see the same trend, other big music festivals. In fact, since Coachella has introduced buy now, pay later options in 2009, usage has jumped from 18% to 60% this year. A huge shift driven by 20-somethings trying to stretch their budgets and capture Instagram-worthy moments without feeling the cost right away. It's also moving into everyday purchases, like DoorDash, a food delivery system. In March 2025, DoorDash announced a major partnership with Klarna, allowing customers to pay for food delivery using installments or deferred payment options. This news sparked a lot of backlash online. Reddit and Twitter lit up with memes and criticism mocking people for financing fast food. So we take these DoorDash loans, combine them, and create a whole new instrument where investors can bet on whether the borrowers will pay off their Taco Bell Crunchwrap Supreme within 12 months. Born too late to ever own a home, born too soon to live for free in the metaverse, born just in time to finance a pizza from Domino's. DoorDash collection outside your door because you can't finance a Chipotle payment, and that's the Sopranos. Um, and then honestly, an interesting insight. Why stop here? A single buy now, pay later contract for a burrito is incredibly risky. Anybody willing to pay for burrito in installments can't be trusted to pay their debt. But what if we pooled their payments together? The risk would go away. That honestly is an interesting notion that we're going to seek to avoid. Now, these examples make one thing clear. Buy now, pay later has gone from a niche financial product to a mainstream way of spending money that people don't really have. Now, it's important to acknowledge that buy now, pay later isn't all bad. There are real reasons it has become so popular. For consumers, it offers a quick, easy way to access credit without a hard credit check. It's appealing for people with limited or no credit history. And many of these loans are interest-free and come with flexible repayment options, which can make budgeting for large or unexpected expenses become a lot more manageable. Think about it. If you drop your phone in a puddle, putting a new one on your credit card might mean paying high interest for months. With a buy now, pay later loan, it makes sense, and you could spread that cost over 4 payments with no added fees if you pay on time. Businesses love it as well. Harvard Business Review ran a study where they found that when companies offer buy now, pay later, purchase likelihood jumps from 17 to 26%. And even better, their average order size increases by 10%. Those gains last for months, not just during promotions. So what's the problem? When misused, buy now, pay later can get dangerous very fast. The main issue is debt stacking. For many users, especially young people, these loans don't even feel real. As one user put it, quote, if I was going to pay $100 today, but then I only have to pay $10, then I've got $90 today to do with something else. It almost feels like you've got some money back. That's what leads to debt stacking, opening multiple loans across different platforms and losing track of repayment schedules. And if you miss a payment, there could be hidden fees. Some companies charge flat late penalties, others up to 25% of the original purchase. Not every plan is interest-free. You have to read the fine print. Buy now, pay later securitization is also on the rise. As buy now, pay later continues to grow, there's another trend happening, the securitization of these loans. In simple terms, the securitization is when lenders bundle these loans together and sell them to investors, which helps them free up cash to issue even more loans while passing the risk on to someone else. Securitization is great in the sense that it allows people to diversify risk among a variety of assets, but how it works in this case is a consumer takes out a buy now, pay later loan from a company like Klarna or a firm. They buy a product from a retailer, and the company pays the retailer up front what the consumer would have paid. The consumer then pays the third party different installments over usually a 3 month period. Then this buy now, pay later company either sells the loans to investment banks or packages themselves into asset-backed securities or a special purpose vehicle, which are then sold to other investment banks and investors. Why do this? For lenders, it boosts liquidity and allows them to issue more loans. It also gives access to a new asset class for investors. And for businesses, it means that customers buy more things, even if they can't afford them upfront. But this is exactly where the red flags begin. In 2008, banks did the same thing with subprime mortgages. Credit rating agencies gave risky loan pools high ratings, and when people started defaulting, the whole system collapsed. Today, the same cycle is starting with buy now, pay later. Companies are offering increasingly attractive payment plans. Loans are being bundled and sold, and the people taking them out, many of them are financially unstable. To be clear, securitization isn't always bad. It spreads risk, creates new investment opportunities, and can make credit more accessible. But it also requires strong regulation and transparency, or it becomes a time bomb. That's why laws like Dodd-Frank were passed after '08. One of its key rules was that lenders and securitizers must keep at least 5% of the credit risk on their books. That way, they have real skin in the game. With buy now, pay later, it's time we apply that same logic. So, what's the solution? The legislation that I propose, first, the sheer volume of buy now, pay later loans is skyrocketing. Adobe Analytics reported that buy now, pay later loans is up 11.5% this year, and providers are issuing millions of loans each week. Second, these loans are increasingly going to financially vulnerable borrowers. They found that 25% of users are now financing groceries and 41% missed a payment in the last year. They must verify their credit score or financial stability with my legislation and have a minimum FICO threshold 580 to reduce default risk. And It essentially allows no more loans to the most financially vulnerable people. Now, third, companies are pushing these loans because they drive sales. Research shows that buy now, pay later increases purchase likelihood and basket size, but those gains come with growing default risk, and providers don't want to hold that risk themselves. So they should be required to hold 5% of the credit risk, similar to the originators and underwriters of the loans. It mirrors the post 2008 Dodd-Frank Act. And fourth, the consumer protection mandate. Consumers don't have the same protections with buy now, pay laters that they get with credit cards. Requires dispute resolution, clear billing, and refund rights. It locks in core protections that were previously rolled back in 2025 and gives buy now, pay later users the same right as credit card holders. Together, these four reforms don't eliminate buy now, pay later. They make it safer, more transparent, and sustainable for everyone. There is a more aggressive approach, ban the securitization of buy now, pay later loans outright. In theory, this forces providers like Klarna or Affirm to keep the loans on their own books, which might reduce risk taking and prevent the kind of diffuse, opaque financial instruments that fueled the '08 collapse. But there's a problem with that strategy. Buy now, pay later is not just lending, it's a volume-based tech business. These companies rely on fast loan turnovers and lightweight balance sheets. Forcing them to warehouse all these dollars that they would lend fundamentally undermines their business model and chokes off access to credit for the very consumers that the model was built to serve. There's historical precedent here. In the past, state-level usury laws strictly limited short-term high-interest lending. And yes, those caps have made loans like this illegal in many states. But when payday loans were banned outright or overregulated, the market didn't disappear. It just moved to less transparent channels or pushed financially vulnerable people towards worse alternatives. In contrast, modest regulatory constraints like those in Dodd-Frank have been more successful. Dodd-Frank didn't ban securitization. It made it safer by requiring issuers to retain risk and disclose more information. That's exactly the approach that my legislation takes. It accepts the reality that securitization, when done transparently, can spread risk, support liquidity, and allow access to structured credit markets. Studies like Ashcraft and Sherman, 2008, show that when securitization is properly structured with oversight, it actually lowers borrowing cost and stabilizes credit supply. My proposal strikes a balance. Instead of banning the practice and risking a credit contraction, it raises standards by limiting volume, enforcing underwriting discipline, and restoring consumer protections that were stripped in 2025. In short, a full ban may sound simple, but it could backfire. My approach preserves the benefits of buy now, pay later and securitization without repeating the mistakes that led to the financial crisis in 2008. Thank you.